Hi viewers, in this video we shall discuss how to prepare ledger accounts under hire purchase system in the books of hire vendor and in the books of the hire purchaser without default and repossession. For default and repossession I have uploaded a separate video. The link I have given it in the description box. Okay, now let's move on to this video. This is the question that I have taken. Mr. Raman purchased a TV on hire purchase on the following terms. Rupees 1200 to be paid on signing the agreement, 1700 at the end of the first year, 1600 at the end of the second year, 5500 at the end of the third year and last year. The hire vendor charged interest at 10% per annum on the cash value of the TV. Mr. Raman wished to provide depreciation at 10% per annum on diminishing balance method. Write up journal and ledger in books of both the parties. So in this example, I am not going to work out journal for you. I am just going to show you how to work out ledger accounts in the books of both the parties. Okay, now first let us see what all information is given in the question. Mr. Raman purchased a TV. So we all know that the buyer is called as the hire purchaser. In this question, Raman is purchasing, he is the buyer. So Mr. Raman will be the hire purchaser. The name of the hire vendor is not given, so he will be the hire vendor. He will be called as the hire vendor. Okay, 1200 is to be paid on signing the agreement. So 1200 is the down payment. 1700 at the end of the first year, 1600 second year, 5500 at the end of the third year. So these are the installment amount. Hire vendor charged interest at 10% per annum. So the rate of the interest is 10%. Depreciation is at 10% per annum. Depreciation is 10%. So in this question, down payment is given, installment amount is given, rate of interest is given, but cash price is not given. So let us see how to calculate interest. So I have uploaded another video which explains how to calculate interest under various methods. The link I have given it in the description box. Go watch that video for a better understanding. Okay, for calculation of cash price, I have provided a table which has 5 columns: year, installment, outstanding balance, interest paid and cash price paid. Okay, for calculating cash price, we should start from the last year onwards. The last year, that is the last payment, is the third year. See, third and the last payment. So the third installment is the last installment. So I am starting the answer with the third year. What is the installment amount? Third year installment amount is 5500. So I have written 5500. Outstanding balance on the third year is 5500. So as I already told you, I have uploaded another video. I'm just quickly going through this. I have explained in that video in detail how to calculate this, what is outstanding balance, how we are calculating this outstanding balance. Okay. So at the end of the last installment, whatever is the installment amount, that will be your outstanding balance. So here 5500 is the installment amount. So the same will be your outstanding balance. On this outstanding balance, we are calculating interest. The rate of interest that is given in the question is 10%. As I have already explained you in the other video, if the rate of interest is 10%, what will you do? 10 divided by 100. Normally 10 by 100 we will write, but since cash price is not given, 100 plus rate of interest. Rate of interest is 10%, so 100 plus 10, it will be 110. That is what I am doing here. 5500 into 10 divided by 110. 500 is the interest. Now how to calculate cash price? Very simple. Installment minus interest. Installment amount is 5500. Interest is 500. So 5500 minus 500. 5000 is the cash price paid. Then after the second installment, the next installment is the second installment. What is the second installment amount? It is 1600. Writing it in the installment column. Then we have to calculate the outstanding balance. When we are paying the second installment is due and also third installment is due. So second installment amount is 1600. Third installment amount 5000 rupees. That also we are calculating to find out the outstanding balance. So 5000 plus 1600. 6600 is the outstanding amount. On this outstanding balance, we are calculating interest. 6,600 into 10 divided by 110. Interest for the second installment is 600. Okay, now cash price. Cash price is installment minus interest. Installment is 1,600, interest is 600. So the cash price is 1,000 rupees. Now first year, that is first installment. The first installment amount is 1,700. So writing 1,700 in the installment column, and we have to calculate the outstanding balance. When we are paying the first installment is pending, second is also pending, third is also pending. So first installment amount is 1,700, second installment amount 1,000 rupees, that also we are writing here, and first installment amount 5,000 rupees, that also we are writing here. Add all these things. 7,700 is the outstanding balance when the first installment is due. So on this 7,700, we are calculating interest 10 by 110. The amount of interest to be paid in the first installment is 700 rupees. So cash price is installment amount minus interest. 1,700 minus 700. 1,000 will be the cash price that is paid in the first installment. Then down payment. We have a down payment in this problem, 1,200 on signing the agreement. So this is the down payment. I am writing it in the installment column. But for down payment, we don't have to calculate interest. So we don't have to calculate outstanding balance also. I have already explained this. Down payment is the immediate payment. Interest will be calculated only for delayed payment. So for down payment, no need to calculate interest. It is fully the cash price. So write it in the cash price column. Now add the last column, 5,000, 1,000, 1,000, 1,200. Add it. The cash price is 8,200. First installment interest amount is 700. Second installment interest amount is 600. And the third installment interest amount is 500 rupees. Okay. Let us see how to calculate ledger account, how to prepare ledger accounts. First, I have taken ledger accounts in the books of the hire purchaser. In this question, the name of hire purchaser is Raman. So, we are preparing ledger accounts in the books of Mr. Raman. The two important ledger accounts that you have to prepare in Raman's book is hire vendor account and TV account. See, hire vendor account and TV account are two important ledger accounts that you will prepare. Okay. Now, I will teach you how to record this ledger without journal. Without journal, how we are going to post this ledger. In a hire purchase transaction, in the first year, what are the transactions that will happen? The asset will be purchased. Soon after purchasing the asset, down payment will be made. At the end of the accounting period, we will pay, interest will become due, installment amount will be paid. Then depreciation will be charged, then interest and depreciation will be transferred to profit and loss account. These are the entries that you have to give for the first year. We are preparing hire vendor account. So, in the hire vendor account, depreciation entry and transferring depreciation and interest to profit and loss account will not be affected. So, I am leaving those two entries. So, we have to give 4 entries. We have to record 4 transactions. One is buying the asset. When an asset is purchased, what is the entry? Normally, when an asset is purchased, the asset will be debited. Asset account debtor to hire vendor account. Here, the asset that is purchased is TV. So, TV account debtor to hire vendor account. If you have to post this journal in hire vendor's ledger, TV account debtor to hire vendor account, we are posting it in the hire vendor ledger. So, what will happen? We will credit TV account. By TV account, in the amount column, write the cash price. We have calculated cash price in the previous calculation. It is 8,200. Write it in the amount column. So, after recording the purchase of asset, the next transaction is down payment. When cash is paid, what happens? Cash goes out of the business and hire vendor is receiving the cash. So, debit the receiver, credit what goes out. Hire vendor is the receiver. Hire vendor account debtor to cash account, that is the journal. Hire vendor account data to cash account, that is the journal. If you post it in the ledger account, to cash account will be debited. And in the amount column, you have to write the down payment amount. See, the down payment amount that is in the question is 1200. So I am writing 1200 in the amount column. So we have recorded purchase of asset and we have recorded down payment. After making down payment, the next transaction is interest becomes due. Interest, we all know, for a buyer it is an expense. It is kind of an expense. So debit all expenses and losses. Interest account debtor to hire vendor account. That is the journal. So interest account debtor to hire vendor. If I am posting it in hire vendor ledger, it will be by interest account. And in the amount column, I am recording first installment interest amount. We have calculated in the previous calculation. Interest for the first installment is 700 rupees. That I am writing it in the amount column. After interest becomes due, installment amount, first installment amount will be paid. When cash is paid, what is the entry? Debit the receiver, credit what goes out. Hire vendor is the receiver, cash goes out. So hire vendor account debtor to cash account. In the amount column, we have to write the first installment amount. See, the first installment amount is 1700 as it is in the question. These are the transactions. Apart from this, we will have depreciation charging entry, transferring interest and depreciation to P&L account. That will not affect hire vendor account, so we are not going to record it. So in the first year, when you are doing ledger accounts in the books of hire purchaser, and when you are doing hire vendor account, in the first year you have only 4 entries. 2 in the debit side, 2 in the credit side. In the debit side, one is for down payment, the other is for installment. 2 cash, 2 cash. One is down payment, the other is first installment amount. In the credit side, you have 2 entries. One is by asset, by interest. So by asset, in this problem it is TV. So by TV, interest, first installment, interest amount. That's all, 4 entries. So tally your accounts and calculate the balancing figure. 6000 is the balancing figure. I hope you all know how to tally the account. I'm not going to explain that. Now bring down the balancing figure. I have brought down the balancing figure 6000 rupees here. Okay, so first year we had 4 entries. From the second year onwards, we will have only 2 entries. One is interest due, the other is payment, installment payment entry. Okay, interest due will be in the credit side, installment payment will be in the debit side. So debit side to cash account, since this is the second year, I am writing the second installment amount. See, second installment amount is 1600. Then by interest account, I have to record the interest for the second installment. We have calculated in the previous calculation, the interest for the second installment is 600. Tally the account, calculate the balancing figure, bring down the balancing figure to the next year. The next year, this is the last year. We have only 3 installments. This is the last year. So in the second year, first year 4 entries. From the second year onwards, only 2 entries. In the last year also only 2 entries. One is installment payment. Third installment payment, it is 5500. Look here in the question, 5500 is the third installment amount, and the third installment interest amount is 500. I have recorded that, and at the end of the last installment, the hire vendor account should get tallied. There should not be any balancing figure. See, 5000 plus 500, 5500. In the debit side also we have 5500. The hire vendor accounts gets tallied at the last installment when there is no default. Default illana, at the end of the last installment, your hire vendor account should get tallied. So I hope this is very simple to understand hire vendor account. First year 4 entries, second year onwards only 2 entries. First year 4 entries, 2 entries in the debit side, 2 entries in the credit side. Debit side 2 cash, down payment, 2 cash, first installment amount. In the credit side, asset account, then interest account, first installment interest amount. From the second year onwards, 2 entries, one in the debit, one in the credit. 2 cash account, the respective installment amount, by interest account the respective interest amount. That's all. At the end of the last year, your account should get tallied. Okay. Then moving on to the TV account, that is asset account. The asset account, in the first year, when we purchase the asset, it will affect the asset account, and when we charge depreciation, it will affect the asset account. Only two entries in the first year. So when we buy an asset, what will be the entry? Asset always shows a debit balance. So debit the asset. TV account debtor to hire vendor account. So TV account debtor to hire vendor account, write the cash price of the asset. In the credit side, we have to charge depreciation. So when we charge depreciation, depreciation is a loss or expense to the business. So depreciation account debtor to TV account, it will reduce the value of the asset. So depreciation account debtor to TV account. If we post it in the ledger, it is by depreciation. And for calculating depreciation, it is given in the question, it is 10% per annum. The rate of depreciation is 10%. So 8,200 is the cost of the asset. 8,200 into 10% will give you 820 amount of depreciation for the first year. Tally the account, find the balancing figure. That's all. Only two entries. To hire vendor account by depreciation account in the first year. Bring down the balance to the next year. From the second year onwards, only one entry, depreciation entry. We have to charge depreciation. See, depreciation is 10% on diminishing balance. So on this 7,380, you calculate 10%. The depreciation amount is 738. Tally your account, find the balancing figure, bring down the balancing figure to the next year. Next year again, we are going to charge depreciation on this balancing figure. Since it is diminishing balance, 6,642 into 10%, depreciation will be 664. Tally your account, find the balancing figure. Sorry, this is written interest wrongly. This is not interest. This is the balancing figure. By balance, carry down, bring down the balance to the next year. That's all. We have to work out only for 3 years. Okay, let us see how to work out ledger accounts in the books of hire vendor. In the previous thing, we saw ledger accounts in the books of hire purchaser. Now in the hire vendor's book, how to work out ledger account. The first account is Raman's account, that is hire purchaser. In this question, the name of the hire purchaser is Raman, so Raman's account. As I told you in the previous thing itself, in the first year we have 4 entries. Since he is the hire vendor, he is the seller, he is selling the asset, he receives down payment, interest becomes due, and first installment amount is received. We have to look into the point of view of the seller. In the point of view of the seller, the asset is sold, down payment is received, interest becomes due, and first installment amount is received. When an asset is sold, the entry will be, here the asset is sold but they are not receiving the price in hand. That is, it is not immediate payment. So the entry will be Raman's account debtor to hire sales account. Debit the receiver likewise. Raman's account debtor to hire sales account. In the amount column you have to write the cash price. Then when down payment is received, what happens? Cash comes into the business. Okay, debit what comes in, credit the giver. So cash comes into the business, cash account debtor to who is giving? Raman is giving. So cash account debtor to Raman's account. So by cash account, in the amount column you have to record the down payment. Down 1,200 is the down payment. So you are recording the down payment. Then interest becomes due. From the seller's point of view, interest is an income. So interest will be credited. The entry will be Raman's account debtor to interest account. So to interest account, 700 is the interest amount for the first installment. Then installment amount will be received. When you receive, what happens? Cash comes into the business. Debit what comes in, credit the giver. Okay, first installment amount is 1,700. See, 1,700 we have recorded. So in the first year, 4 entries. 2 in the debit, 2 in the credit. In the debit, higher sales and interest. In the credit, cash down payment and cash installment amount. Okay, Tally your account, find the balancing figure, bring down the balancing figure to the next year. From the second year onwards, only 2 entries. Interest and installment. Interest, see, second installment amount 600 and we receive second installment amount, that is 1600. See, 1600 is the second installment amount. So buy cash 1600. Tally your account, find the balancing figure, bring down the balancing figure to the next year. Next year again 2 entries, interest entry and cash. So interest 500 is the interest for the third installment and 5500 is the installment amount of the third installment. Tally your account. Your account should get tallied at the end of the last installment. If there is no default at the end of the last installment, the account should get tallied. So here also the account is getting tallied. Next you have to prepare interest account. Interest account is very simple. Every year interest becomes due and it is transferred to P&L account. So when interest becomes due, the entry is Raman's account debtor to interest account. So in the credit side by Raman account, first installment interest amount. We will transfer it at the end of the accounting period. We will transfer it to profit and loss account. So the entry will be interest account debtor to profit and loss account. We are transferring it to profit and loss account. It gets tallied. It becomes due. We transfer it to profit and loss account. The account gets tallied. The second year also the interest becomes due. We transfer it to P&L account. Third year also it becomes due. We transfer it to P&L account. That's all. Every year the interest account gets tallied. So I hope you understood how to post ledger in the books of hire vendor and in the books of hire purchaser. Thank you for watching.